Hi, Sandip. Thank you very much for joining us today. How are things in Toronto?
Things are good. Thanks for having us, Jimmy.
Sandip, Franco Nevada was the first ever royalty company having been established in 1982, so it has a very rich history in the royalty sector. And before we jump into your various assets and operations, why don't we just start with a brief history of Franco because it really speaks to the optionality associated with this sector.
Sure. I could go on for a while, but I'll give you a quick snapshot. Company, as you said, started in 1982. Two gentlemen, Seymour Schulich, Pierre Lassonde. Seymour was the oil and gas investor. Pierre was the mining guy. They started, a mining company with the intention of being like any other mining company. Go out, stake some land, drill it, hopefully find a deposit, build a mine. But along the way, Seymour said to Pierre, on the energy side, there's lots of royalties on properties. Is that common in the mining business? And Pierre said, for sure, Seymour. And so in 1986, they spent all the money they had, which was about $2 million, and they bought a royalty on a small little property owned by a third party. The property was called Goldstrike, had about 500,000 ounces of resources on it. So as I said, they spent the $2 million. A few years later, American Barrick, which is now Barrick Gold, went in and bought that property. I think they paid about $75 million for it at the time. Turned it, did some deep drilling and turned that 500,000 ounces into over 50 million. So that $2 million investment to Franco has paid almost $1 billion, and the mine's got another 10 plus years to go. So that is really, as you said, true power of optionality and a perfect case. And from that point onward, Franco Nevada just became a royalty company, and then, as you can say, the rest is history.
So that one asset was a company maker, not just for Franco, but also for Barrick.
Oh, absolutely. For us, from Franco, it evolved into becoming just a royalty company and accumulating royalties over time. And for Barrick, where their share price went after that allowed them to do acquisitions subsequently. So absolutely, company maker for both companies.
So that's I love that story. Now let's move on to your assets, just to provide a brief overview of Franco Nevada and the breakdown between the mining side of the business and also energy.
Sure. So Franco is the largest royalty streaming company by market cap and by number of assets. We've got over 400 assets, 112 producing, split between mining and energy. And then we've got over 200 exploration assets. For us, we think of diversification as our strength. So obviously we're a precious metals royalty streaming company, but we think that diversification reduces risk in the portfolio. So for us, we will always do precious metal deals, but we've typically done energy as that diversification, but we have copper, we've got nickel. And then last year we did a royalty on Vale's Brazilian assets for iron ore, which we consider the best iron ore assets in the world. So, being able to do that additional non-precious metal commodity adds diversification and, as I said, reduces risk. So for us, as I said, we've got the largest portfolio, most diverse, and we think it's one of the strengths of Franco.
So your single largest asset on the mining side is First Quantum's Cobra Panama mine, which is a large copper mine in Panama. It continues to ramp, providing significant cash flow for both Franco Nevada and also First Quantum. Why don't we just start with an overview of this asset and an update on what's going on the mining side?
Sure. So Cobra Panama, as you said, First Quantum, they built it and they've ramped it up and have done a great job on both fronts. It's one of the largest copper mines in the world. Right now it's doing 85 million tons per year. First Quantum has announced another expansion to 100 million tons per year. So that's underway now. So we'll start benefiting from that in 2023. So what Franco has, we have a precious metal stream here. So for every pound of copper that gets produced, Franco receives a certain amount of gold and silver. And that is for the life of the mine. And so for us, it's our largest asset. It's our largest revenue generator. But even then, it's less than 20% of our revenue. And First Quantum, just recently, I think they released the results last week, and they've upped their guidance for 2022, 2023 in terms of their copper production guidance, which will be a bonus for Franco for the next couple of years. And as I mentioned, after that, the expansion kicks in. And to be honest, me personally, I believe there'll be further expansions at this mine. It's world class. It's pretty simple mining, and it's a very large land package, which we think has huge exploration potential.
And one of the great things about these large copper mines or base metal mines is their mine life. A gold mine might have 8 to 10 years, whereas these large copper mines, it could be 20, 30, 40 years. What's the mine life on Cobra, Panama?
So reserves is about 30 plus years right now, but when you factor in resources, we think this mine will be in operation for 50 plus years. We think it'll be the longest life mine within our portfolio, that and Antamina. Antamina is another copper asset in Peru. It's operated by a consortium of BHP, Glencore, Teck, and I believe it's Mitsubishi. We have a silver stream here on Teck's 22.5% interest. And again, it's one of the lowest cost copper assets in the world. Right now, the limitation is tailings capacity, but once they get new tailings capacity permitted, the resource is basically the same grade as the reserve. So again, we expect this mine to be in operation for 50 plus years as well. So it gives a nice strong foundation of cash flow to Franco.
And Sandip, I just want to ask one more question on Cobra, Panama. When did you initially make that investment, and when did it start cash flowing?
So we did the initial deal in 2012, and we did it with a company called Inmet Mining. They had a $6 billion capital cost to build the mine. And so we were putting in $1 billion at the time, and they were raising money through high yield debt and other sources to fund the construction. Before construction started, First Quantum acquired Inmet and then rechanged the engineering plan on mine development. So the mine started construction a few years later than it was initially intended, but our money didn't go in until it started construction. So it wasn't as if we'd put in the $1 billion right away. At the end of the day, we ended up putting in 1.35 billion. And the mine, our first cash flow was in 2019 when the mine started.
So from your perspective, you really have to be patient when you enter into these agreements.
Oh, absolutely. And that is, I think, one of our strengths is because we have such a large portfolio and a diverse portfolio, we can be patient. Jimmy, I'll tell you, there's deals that we've done. So I'll give you an example. Hudbay has a property in Arizona, which they're trying to get permitted, called Rosemont. We bought that royalty in 1989 for less than $1 million. So, you're going on 30 plus years now, and the mine is not built, but, they've got a new discovery called Copper World. If that gets permitted and built, that $1 million investment will be paying us 20 million plus a year in revenue and for the life of the mine. And so, yes, it's taken a long time, but patience is what you have to do. And by having a larger portfolio, it gives you the ability to be patient.
Wow, that's a great story. So another significant asset in your portfolio is Lundin's Candelaria mine, which is another large copper mine in Chile. Why don't you just provide an overview of this asset and also tell us what's happening on the production side?
Sure. So we helped Lundin buy Candelaria. If you recall, 2014, we had a bit of a base metal pullback. Copper went back to $2 a pound. And so you had a lot of the mining guys had leveraged up their balance sheets and needed some assistance in helping reduce those debt levels. Freeport, which was the owner of Candelaria, decided to sell the mine. We assisted Lundin in acquiring it. I believe they paid 1.8 billion, and we did a stream and a little bit of equity for 655 million. At the time, the mine had 14 years of reserves. Lundin's done an unbelievable job on the exploration front. And today the mine life is 25 plus years. And considering that it's already mined at 7 years from when we acquired it, so that 14 years has turned into over 30 years. Again, it's the power of optionality and our business model. So as I said, the mine life is longer. Lundin's done a very good job on the exploration front. It has had some challenges the last couple of years on the operational side, but we believe that's behind them. They have given out their guidance for 2022. It's a little lighter than it was in 2021, but as they improve the operations and the high grade underground comes into play, we expect higher production from Candelaria 2023 onward.
Sandip, as you mentioned, 80% of your portfolio is focused on precious metals and 20% is focused on other resources. Energy is making up a large component of that other 20. So I want to spend some time here. And the oil price is over $90 a barrel now, the highest it's been since 2014. And as a result, your energy revenues are significantly higher year over year. But before we examine your energy assets, why don't you tell us why you ventured into energy?
So as I said at the outset, Seymour Schulich was an oil and gas investor, and we liked the ability to sort of hedge the precious metals. Those two commodities sort of tend to trade opposite to each other. So in the early 90s, we ventured into Western Canada and bought royalties out there, and those oil and gas royalties are still paying today, decades later. So really, even though it's a different commodity, the whole business model and the premise of optionality and commodity optionality is still there, whether it's energy or the mining side. So we've always done that in Western Canada. But when oil dropped in 2016 to about $30 a barrel, we finally ventured into the United States, and we looked in the US and we said, which are the basins that will survive if oil demand falls or if prices fall? So basically the lowest cost basins. And that was the Stack Scoop in Oklahoma and the Permian down in Texas. And so we bought royalty packages down there. And at the time, I guess the average price that we paid was $55 a barrel. Obviously, in 2020, there was the big dip in energy prices because of the pandemic. But as you said, we're back over $90 a barrel. It's a volatile commodity. We appreciate that, but we think we've invested in good assets, and we think they'll contribute for the next few decades.
And I'm sorry, what's the breakdown between mining and energy revenues?
So right now, energy is less than 20%, and it's fluctuated over time. It's been less than 10, up to 20%. It's about 17% last quarter. Obviously, you don't know what the commodity prices are going to do, but as we continue to grow Franco Nevada, I think energy will become less significant within the portfolio.
So your most recent acquisition on the energy side was the Hainsville natural gas asset. Why don't you just provide a brief overview of this?
Sure, yes. So we bought that in early part of 2021. It's a royalty package in the Hainsville. The main operator there is Rockcliff. At the time, natural gas was $2.50, I believe, and obviously we've been over $4 for some time now. So it was a very good deal. The last two deals we've actually done in the energy space have been natural gas transactions. We think natural gas has a longer life than fossil fuels. We kind of look at it as a transition fossil fuel. So for us, we did a $300 million deal in the Marcellus with Range Resources, and then obviously the Hainsville, as you mentioned. So I would say we're tending towards the natural gas side of the business versus the oil side, but those assets have performed very, very well, and the payback on Hainsville is going to be half of what we expected based on current commodity prices.
And given the success and the growth within your energy business, would you ever consider a spin out of these assets into a separate company?
It's a good question. We have looked at it a few times. Obviously, whenever oil spikes, we do take a look at it. Two things with it. Number one is just energy within Franco trades at a very different multiple than a standalone energy royalty company. Because if you go out there and you look at the Vipers of the world and the Prairie Skies, they do trade at lower multiples. So it's not exactly value accretive to Franco shareholders. That said, it's not something that we are opposed to. As I said, we've looked at it. But right now, we think the energy portfolio adds some balance to Franco's portfolio. And we don't intend to grow it at this time, so it should diminish over time. And we think it just provides diversification, and with that comes reduces risk. So we think the best place for the energy assets is within the Franco portfolio at this time.
That's a great overview of your mining and energy assets, Sandip. Why don't we move on? I want to look at your balance sheet now and just tell us how much cash do you have on the balance sheet and how much liquidity do you have available to pursue new agreements?
Sure. So we've got roughly $500 million in cash and investments on the balance sheet. When you add in the credit facilities, we've got about 1.4, 1.5 billion. Obviously, we have more than that. We could increase our credit facility easily, but the reality is we never intend to draw upon it because we don't believe in leverage of that size. So we've got ample firepower to go out and do further deals. And that's what, we're out there looking at the market, but we're only going to do good deals.
And Sandip, you've been relatively quiet on the deal front in the past year, and you also increased your dividend just recently. Does this mean there are a few quality deals that meet your standards?
The deal pipeline is actually quite active. At the end of the day, we have a process we go through. From a technical standpoint, we have a technical committee from the board, which we have to go through on our deals. And we have our criteria. And if it doesn't meet our criteria, then obviously we don't move forward. That comes into play with valuation. Our fundamental policy or philosophy is we will only do good deals on good assets. That's not to say that the assets out there, the deals out there are not good assets. It's just that, maybe we had a different view on optionality on the upside, or maybe we weren't as aggressive on the pricing. But we've looked at a lot of things. We haven't been able to complete them, but the pipeline definitely is active.
And if you can't find deals that meet your standards, does this mean we can expect higher dividends in the future?
It's a balance. Our number one goal for the company is to grow the company, and we believe we can. So we want to deploy our capital to add assets to the portfolio. If you look at the last 10 years, we've done anywhere between 600 and 700 million a year in deals. Obviously, some years more, some years less. Even if you look at 2021, we did over 850 million in deals. So that is the priority for us of where capital will be deployed. But second to that is obviously returning to shareholders. We've paid about 1.7 billion in dividends since our IPO. We've raised the dividend every single year. And in fact, just 2 weeks ago, we announced our dividend increase for 2022, 7% to 32 cents US per share per quarter. As I said, that's 15 years of increases. Our philosophy on the dividend is progressive and sustainable. So, if you look at the gold price, it was $750 at IPO. It went all the way up to $1,900, back to $1,050, and now we're back to $1,800. During that volatile movement, we raised our dividend every single year. And that is our objective, is to raise it every year, regardless of what's happening with commodity prices. We do get asked the question, would we tie it to some sort of formula? And the answer is no, because if commodity prices are retreating, the likelihood is that your share price is retreating as well. So you don't want your dividend cut at the same time. We want to do the opposite. If the share price isn't performing as well, at least you're getting a higher dividend. And so that is sort of our philosophy. So we do intend to continue to increase the dividend, as I said, progressive and sustainable.
So that's a great overview of your assets and your balance sheet. And I want to move on and just ask you a few general questions about the royalty and streaming business as a whole. And I want to start with how the royalty and streaming business has evolved over the past decade.
It's come a long way. Like when I rejoined Franco in 2010, streaming was sort of or royalty and streaming financing was sort of a financing of last resort. Companies would look at debt, equity, equipment refi, all those other avenues of raising money, and royalty streaming was last on the list. If you look at it today, if you're a CFO of a small junior company or a CFO of a large major, and you're looking at raising funds, you're looking at streaming or royalty financing. It is common, and I don't think you can walk into a boardroom and have a discussion with your board on financing without royalty streaming being at least one of the items on the list. Whether you go through with the process or not is a different question, but it's become accepted. It's proven. You've got companies like Barrick and Glencore and Teck that have done it, and even larger companies than that have looked at it. So from our perspective, it's come a long way. It's widely accepted. And you just look at the number of companies in the royalty streaming space now. Every month, I think there's a new small junior royalty company coming out. which tells you that people have accepted the model.
I want to move on now and discuss jurisdiction. A large percentage of your assets are based in the Americas. And given the size of your business today and also the diversification of the revenue stream, would Franco Nevada consider moving into a more riskier jurisdiction? And I'm thinking about West Africa or maybe parts of Asia.
We would. Firstly, it all starts with the deposit. What is the asset like? What's the upside there? Does it meet our technical criteria? And then from that point, you look at jurisdiction, you look at structure, how do you protect yourselves? But we have such a large, diverse portfolio that, adding an asset in a potentially more riskier jurisdiction can fit within the portfolio because you're not betting the company on it. And the reality is it comes down to what's the dollar size that you'd be willing to invest in one of these jurisdictions. Putting 5% of your NAV or roughly $500 million into one of these jurisdictions is a risk I think we can afford to take. Again, just because we are so diverse and we have, the majority of our assets in proven jurisdictions, mining friendly jurisdictions. So we can accommodate that risk. But again, it just comes down to what's the quality of the asset.
We already discussed the success of the Goldstrike royalty and how profitable that's been for Franco Nevada. Are there any other assets that have been as profitable or nearly as profitable?
Yeah, I think, by having such a large portfolio and looking at the history, every year, every couple of years, you get these surprises, right? If you just look at our IPO portfolio, you had Detour, which was a shutdown mine, and restarted, or rebuilt, restarted, and now it's up to 30 million ounces. Tasiast, same thing, small little mine. Now it's Kinross's largest asset. Duketon in Australia with Regis Resources. So every few years you get these assets that just pop out of the woodwork, or positive news it comes out and you benefit from that. And the beauty of that, it's all organic growth. So the cost to Franco is zero. And even if you look at it today, as I mentioned, Cobra Panama is doing an expansion. Stillwater is doing an expansion. Detour is expanding. Tasiast, Subika, I can go on. The list is extensive. So again, that's all organic growth. And then those royalties that we've bought over the last number of years, those mines on those undeveloped are now getting built. Goldfields is building Solaris Norte in Chile. The JV partners Orion and Equinox at Greenstone have announced they're moving forward with that construction. Seguela with Fortuna is under construction. We expect Valentine Lake with Marathon to be built. So all that organic growth over time, you just have to be patient, and it's all cost free to Franco. And I think there's a slide in our deck which is just ideal. It shows our IPO assets and how they've grown over time. So at our IPO, we had about 30 million ounces of gold reserves on those assets. Fast forward to the end of 2020, those same assets have 70 million ounces of reserves on them. Meanwhile, 40 million has been mined. So that 30 million turned into 110 million, and in between, 1.6 billion in revenue was paid to Franco Nevada. So those assets have 3 times as much on them than when they were at IPO. All of that with no cost to Franco. So I love that slide. It's in our deck, and it basically, in one slide, showcases the true optionality within the Franco model.
Is there one asset on the exploration side or the development side that you think holds a lot of promise?
There's a number, but the one I will reference is the Ring of Fire. So this is an underexplored area in Northern Ontario. About a decade ago, Cliffs Resources went in and bought and accumulated a large land package there. It has the highest grade chromite deposit outside of South Africa. We know it's got nickel, copper, platinum, palladium, gold, silver. All the metals are up there in some form. There's been some drilling, but there's no infrastructure to get there. In 2014, 2015, Cliffs ran into trouble and decided to sell it. After putting in about $1 billion, they sold it for 25 million to Noront Resources. We loaned Noront the money to buy the asset. So that loan will get repaid to us. At the same time, we wrote a bunch of royalties, anywhere from 1% to 3% on the land package. And so recently, Noront has been taken over. There was a bidding war between BHP and Wyloo, and it looks like Wyloo Metals, which is run by Andrew Fortescue, looks like they're the winning bidder. And so, we think that obviously there's a highway that's needed to allow access into that area, which the provincial government will fund. It's about $1 billion cost. But if you're the provincial government, you want to know that on the other end of it, you've got a deep-pocketed miner who has the capacity to build mines and do exploration. So Wyloo is that party. So, we're actually quite excited. This isn't something that's going to come into play in the next 5 years, but this is something that, in a decade, maybe a bit more, we think could be an unbelievable win for Franco and likely for the next management team. But it goes to our long-term thinking, that we're not just thinking about this year or next year, we're actually thinking for the next 10 years, 20 years on how to continue to grow this company. So we're actually quite excited with the Ring of Fire.
That's another great story. Thank you for sharing it. Sandip, as we wrap up, Franco trades at the highest multiple of your peer group. Depending on whose research you look at, it could be anywhere from 2 times to 2.5 times price to NAV. Why is Franco trading at such a rich premium?
Good question. And, investors ask us that all the time. I think it's a number of factors. One is our track record. We created the royalty model back in the 80s, been doing it for 35 plus years. And I think over that time frame, we've shown that we are good allocators of capital. And so part of that is also the technical skill set, not of just management, but the board. I think we have one of the best boards in the mining business. And so I think that track record, it's part of the reason why we trade where we do. Secondly is the portfolio itself. As I said, it's the largest and most diverse, whether it be by asset, commodity, geography, operator. And so with that comes lower risk. So we think Franco is the lowest risk way to invest in gold and precious metals. And then I think finally, it's just the owner mentality. Management and the board own over $200 million worth of stock in Franco. That's multiples of what our peers own. And so that impacts us 2 ways. One is how we run the company in terms of spending money and our G&A. If you look at our G&A, it's been pretty well consistent for the last 10 plus years. And that's because we treat our cash as if it's shareholder cash. And secondly, in doing deals and allocating capital, again, because we're owners in the company, we're only going to do deals on good assets, and we're not going to chase deals and do deals just to grow the company. So I think when you look at all of that, you look at the track record, you look at the diverse portfolio, you look at the owner mentality, those things combined, I think lend to where we, our valuation and justifies our valuation. And it goes to our tagline. We think Franco Nevada truly is the gold investment that works.
And one more question before I let you go, but because Franco is trading at a rich premium of 2 times price to NAV, would you ever consider buying another royalty company that's trading at 1 times?
We've done M&A before. 2 things on M&A. One is just due diligence. Do you get the ability to do due diligence? And then in a lot of cases, the contracts, obviously you haven't written them yourself, so it might not have the protections that you do. If a royalty company or streaming company was trading at 1 times NAV, it would make sense for us to look at it, but we'd have to question why it's trading at 1 times NAV, as most royalty streaming companies trade above that. We still think the best way and the real way to create shareholder value is to do deals ourselves, where we have the ability to do technical due diligence and write our own contracts, and buy assets at 1 times NAV. So that is the priority. But if a mining company was trading at 1 times NAV, it would obviously make sense for us to take a look. But we do our due diligence.
Sandip, that's a great update and overview of Franco Nevada, and I want to thank you for spending time with us today. And to all of the viewers, if you have any further questions for the Franco Nevada management team, please send us an email to info@bloorstreetcapital.com. Sandip, once again, thank you.
Thanks very much, Jimmy. Appreciate it.